Hi, this is Yeho. I'm a option trader. Today is Saturday, May 16, 2026. It's around 10:04 a.m. here in Japan. Today, I want to look back at this week's market and talk about something very important happening beneath the surface with both the bond market and the stock market. First, let's start with Japan. The Nikkei closed at 61409 yen on Friday. The market still looks very strong overall, but after such powerful rally, we are now seeing some consolidation near the highs. AI-related stocks, especially memory and semiconductors names, continue to surge. Daily trading volume of 8 to 9 trillion yen is becoming normal now, which shows how aggressive capital inflows have been become. Volatility has also cooled down a bit. The volatility index is around to 9.7, so the market feels calm compared to previous weeks. At the same time, EPS growth is becoming very strong. Nikkei EPS is now about 3,200 yen, and ROE expectations are rising rapidly. Personally, one of the most important things I'm watching right now is ROE expansion in Japanese equities. It feels like Japan is slowly transforming into the more American style equity market, where investors focus heavily on capital efficiency and shareholder returns. But at the same time, something else is happening. The Japan's 30-year government bond yield it has moved above 4%. And in the United States, the 30 Treasury yield is also 5% above. Historically, this combination should look strange. Normally, rising yield should pressure stocks valuations. Higher interest rates than usual means lower stock price, but that is not what is happening now. Stocks continues to rise even while long-term interest rates move higher. So the question is why? I think the answer is that we are entering a completely different market structure. Government issue bond in order to realize capital. The pattern has not changed, but the destination of the capital has changed. Today's government are increasingly directing capital toward AI infrastructure. Does include a data center, a semiconductor, power infrastructure, energy system, communications, robotics, space infrastructure, and AI ecosystem overall. In other words, government debt insurance is increasingly connected to AI competition. The final goal is not simply economic stimulus anymore. The final goal is winning the global AI race. And because of that, stock indices themselves are becoming AI indices. In Japan, companies like Software Group and semiconductor-related firms are becoming larger and larger part of the index. In the United States, the same thing is happening with companies like NVIDIA, Microsoft, Amazon, Meta platform. As AI companies absorb more market value, stock indices themselves have become increasingly dependent on AI growth. And that changes a relationship between bonds and equities. In the old market structure, people believe higher yield and lower stock price. But now the market may be thinking differently. Rising yields may actually signal stronger national investment into AI infrastructure. So instead of the raise up that means stock down, the market may not be saying later up means AI investment is accelerating. And that is very different framework. Of course, there are still risks. We recently saw warning from organizations like the Financial Stability Board about stress in the repo market and the leverage inside the non-bank financial institution. And yes, if bond market become unstable, the bond market can also become unstable. Traditionally, that should create a sharp sell-off in equities, but today there may be another force of offsetting the pressure. As AI stock continues to rising, and realized gains inside the equities market become larger and larger. Those gains themselves can stabilize the financial system. So now, bond market and the equities may no longer be fighting each other. They may actually be shifting in the same boat. That's the key point. The government issues that the debt finance AI infrastructure. AI infrastructure boosts AI companies. AI companies lift stocks index. So rising yield and rising stocks price can happen at the same time. And may that is exactly what we witnessing right now. The age of AI value absorption, era where AI become powerful enough to absorb the negative effect of rising sovereign aid. Now, of course, this structure is not permanent. If AI growth slow down or if sovereign debt becomes too unstable, this balance could break very quickly. But for now, I think this is one of the most important structural shifts happening in the global market. Anyway, those are my thoughts for today. Thank you for listening. Please follow my contents, long put option. See you tomorrow.